I said go live. I think Pulverizer, if you could please check again. I think I am. Um, I don't
We got
know.
Sunny Mexico, Dividend Gypsies from Mexico on here. All right. Where you at from Mexico, Dividend Gypsy? All right. You keep talking tomorrow. I'm just going to watch the comments. Keep going.
All right. So benchmarks are important. I think a lot of people get confused with benchmarks. A lot of people make financial decisions based off of benchmarks. Sometimes they're irrational, sometimes they're rational. It is all right. It seems like it's working. All right. So it is an important part of the financial planning process and kind of judging if you're in the right place. So, and if we're on the right track. So, if you could put the slides back up, Josh.
Okay. Let me bring them up again here. Oh, wait. I got to do like this.
Thanks.
Oh,
you trying to shrink me? Honey, I shrunk the kids. Remember that movie?
I never saw it.
My kids watch it. But
cool. I never saw that movie, Mara. However, have you ever the best movie for your kids of all time? Are you ready for it? Literally, if your kids watch this, it'll love you forever. It's called Hoodwinked. Have you ever heard of Hoodwinked?
Nope.
Dude, that's literally the best movie of all time, without question. It's funny, it's awesome, it's fantastic. Watch Hoodwinked, and you will never be the same. It's great.
Yeah, I'll need to find a VHS cassette tape.
You can download or do it on Amazon.
All right, let's get back to this. So what is a benchmark? You know, a benchmark is really a standard of measure to compare your returns against a given portfolio. So a lot of things that we see with benchmarks is really to compare your return to a benchmark. And I think a part of that equation that's missed is the risk component, right? So you could be comparing your equities to, you could have small caps, mid caps, and everything else, and comparing it to S&P 500. Well, they're two different things. Thank you. So how do you select a benchmark? Well, with so many different benchmarks, I was actually going to share a spreadsheet. I wasn't able to put it into the PowerPoint, but there's almost, for an advisor, for our portfolio performance tools that we have a choice of 3,853 different benchmarks to show clients.
Wait, you have a choice through who? Like Schwab or Fidelity or something like that?
BlackRock. So we use BlackRock or Black Diamond as our portfolio management tool. And there's over 3,500 different benchmarks that are out there that you can use to. So it's very hard to choose from, right? And there's certain things that you want to consider, right? First, you don't want to find some very specific benchmark that's out there that doesn't relate to your situation, right? You also want to make sure that this is a transparent benchmark, that it's widely used, right? That you can actually invest in, right? Like you can buy an S&P 500 index fund. You want to make sure it has daily liquidity, low turnover, so that you're not comparing to your portfolio to a benchmark that's constantly changing, right? And you want to make sure that they publish risk characteristics around that benchmark. And I think this is my first point that I'd like to drive home. Is
Can you make that a little bit bigger by chance? This is kind of
no.
Okay, I got you.
That's sorry.
That's all right.
It's small font. But hey, the risk characteristics are huge because you could have a portfolio that underperforms, let's say, for example, the S&P 500, but is taking 40% less risk, meaning 40% less on the downside, right? And you may only be giving up, 20% on the upside. And that, to me, would be a good risk-adjusted return relative to the benchmark, right? So it's not just total return that we're trying to compare for here. And obviously, you want to compare apples to apples. You don't want to be in a 100% bond portfolio comparing to the S&P 500, right?
Exactly.
I think that most people would agree with that. So I want to start with, how does the industry choose an appropriate benchmark? So I'm assuming most people are investing themselves and they're educated, or they're using a financial advisor, and the financial advisor is choosing the benchmark, right? So how do we know we're choosing the right benchmark, right? So Josh, you'll laugh at this. When we were at USA, there was a 2-question risk tolerance questionnaire to figure out what portfolio you should have. And it was basically from 0 to 100, where would you rate yourself as in the portfolio in terms of how much risk you would want to take on? And then the second question was, how much downside are you comfortable taking on, right? With those 2 questions, using statistics, you could figure out what type of portfolio somebody should be on. When I first started in an RIA, my compliance attorney gave me a 6-question questionnaire for a risk tolerance questionnaire. And the problem with these risk tolerance questionnaires is that they don't really digest your appetite for risk versus reward, right?
Exactly.
It's just looking at your personality type. Look, I don't go to Vegas. I don't gamble. Oh, that means you should be a conservative investor, exactly. Right? Or when you're driving on the freeway, do you go the speed limit, above the speed limit, or 10 miles below the speed limit? And that is really a preference for that risk, like within a car. So it's a risk tolerance questionnaire. Most of the times will get you in the ballpark, but may not get you your right portfolio. In that risk tolerance questionnaire, you figure out the portfolio, and that's considering the assets to allocate to. And then you have to identify appropriate benchmarks to those assets. So most of the time, Josh, do you remember what it was? S&P, Wilshire something, Russell 1000, emerging markets, and some combination of that
the XUS, I forgot what it was, the MSCI,
yeah. And so getting those, different things to create a portfolio, to compare your portfolio to that benchmark, will give you kind of where you are in terms of outperformance of the benchmark or underperformance of the benchmark. One thing to keep in mind is when you're using these benchmarks, you can't actually invest in them directly. You have to use an index fund. And with an index fund, there's an associated cost. So most of the time, the benchmarks are a gross return, not a net return. And that's something to keep in mind.
And just real quick, Amar, the indexes also have tracking errors as well. So it's kind of like you can actually never really be compared apples to complete apples with an index fund, because Amar said there is fees on that, not much generally, but there's also tracking error. So
yeah, there's a question from Dividend Gipsy about what do you find important to measure from a risk standpoint? Beta. If you have a 1-asset portfolio, beta compared, a benchmark's beta versus your beta would be highly a good place to start. But maybe covariance, because most people don't have just a 1-asset portfolio. So how do all these different assets invested together, what is the volatility of that bundle of assets relative to the volatility of the benchmark?
And he said standard deviation too. You want to talk about that at all?
Yeah, so covariance is a measure of standard deviation averaged out on a weighted scale. So that takes part of that. Yep. So how do we do it? So I think for our clients, when we talk about performance and benchmarks and everything else like that, we like to use a framework that has 4 benchmarks, because it tells a larger story than just like, how did I do against this, right? And so first we got to figure out where is the market, right? And that's the first part here. The second part here is to figure out, well, how is your strategy doing in this existing time frame, right? And what we do is we manage a dynamic risk model that reduces the risk when the environment has more risk in it, right? And that doesn't mean we get it right every time. I'm looking at the freeway here, Josh. There's a beautiful 805 right there.
Yeah.
And in San Diego, the speed limit on that freeway is 65, and you'll find people going 85 miles per hour and making it home safe, right? In fact, it could be raining, right? And they can make it home safe. So just because the environment says that it's dangerous, you could take on a lot of risk and you could get paid for it sometimes, right?
And then there's Amar driving in the left lane going 55 miles an hour.
Hey, I got 2 kids and Expedition, I'm taking my time. I am no rush.
In
I
the
am
left
telling you.
lane, though, Amar. You're like, I'm not getting over for nothing.
No, I'm not in the left lane. That's for people that want to take on that risk of going super fast. And you're right, pulverizers. Speed limits are bogus. Speed limits were created for the gas, making sure that we save gas and stuff like that when oil embargoes were going. But so in our model, to go back to this, if the environment is risky, it's kind of like the new cruise controls that you have. So in 2000, you had cruise control. You set it to 70 miles per hour, and it stayed at 70 miles per hour, regardless of the environment. That's what strategic asset allocation does. In our models, we decrease the risk when the environment says that there's more risk. So if somebody cuts you off, and you have the adaptive cruise control where it automatically slows down, we'll decrease the risk, and then we'll take it back up to maximum risk that a client would define. And then lastly, you got to define your time frame, and I can't stress this part enough, because a lot of people take their year-end statements and they say, well, how did I do against the S&P 500 this year? How did my portfolio do against my benchmark? I don't think that's an appropriate time frame to look, because as a portfolio manager, I'm not making decisions on a year-to-year basis. I'm making decisions based off a market cycle. So I would highly stress that when you're meeting with an advisor or you're talking about your benchmark, you got to know how much risk the benchmark is taking and what is the return. And then that period of time that you want to look at is one market cycle, right? So you're capturing more data. And a good example of this would be, if you're in an aggressive portfolio when the market's going up and you're in an upward cycle, yeah, you're happy and you're looking like a rock star. But if you're in a downward cycle, do you want, if there's more risk in the environment, do you want to take on more of that risk, right? And relative to that benchmark.
So let me ask you a question. Like, how do you determine more risk in the environment or not? Like, what's your mechanisms to assess?
Yeah, that is a good question. So we used we have, let's just say, I'm trying to explain it in an easier way, is that we have 7 gate checks that we look at, and those gate checks either say risk on, neutral, or risk off. And then we average the score of those 7 gate checks, and then we get what should our portfolio be. Should be risk on, or we're taking on risk? Should it be risk off? Meaning that all those are, a neutral or red lights, and based off of that, we can follow the trend of the markets, right? So
are you looking at like every week, Amar, every day, every month, or what?
Yeah, so we look at the trend of the markets on a weekly basis, and we're adjusting. Yeah, and we have risk bands, so it's not necessarily we're making a trade every single day to adjust, because that would blow up somebody's taxable consequences, wash sale rules, etc. But yeah, we look on a weekly basis for trend analysis.
Yes,
So the first thing here is, this is our 4-pillar way of looking at benchmarks, right? So the first key benchmark is the broad markets, right? So let's define the broad markets. Most of us define the broad markets as just the S&P 500, right? So as of when I created this deck 2 days ago, the S&P was up 8.31% year to date, right? The Bloomberg Aggregate Bond Index, which used to be the Barclays Index, is down about 2% year to date.
You know what it used to be before the Barclays Index?
No.
The Lehman Brothers. Isn't that crazy?
Oh yeah, Lehman Brothers. Yeah.
That's crazy.
Yeah. Commodities are up 2.24%. Again, that points to inflation re-accelerating, right? So, and then we look at cash, right? So, if we have money, we can, in the broad markets, we can use it to these 4 broad market indexes. The second thing is we got to look at our strategic allocation, right? Like, how is the model doing, right? The way we do that is that we compare our model, and I know this is small, but this green line here is the client first capital benchmark, right, for the one portfolio. And this blue line is what this client's actually done, right? And one of the things you can see here is the client's up 4% and the benchmark's up 4.78%. And you go, I wonder why we're outperforming the benchmark. And if you look at the assets, you'll see right here, I don't know if this is coming across, Josh, but there's about 700,000 or so in cash, right?
Yeah.
So we would expect some underperformance. So it's not only, so we want to look at return, risk, and then why are we different, right? So
Right.
using that 3-frame model, it can really articulate what's going on in a portfolio. So
100%, Amar. You're like, no, we have so much cash, and the cash is only up 1.1. Thus, we're underperforming, and that's that is that really underperforming though when you factor in the risk-adjusted returns. That's what you have to look at. Absolutely.
Exactly. So the other thing that we want to do is look at a granular level. Well, hey, are we picking the right securities relative to the benchmark, right? So if we've used the S&P 500 for the benchmark right here, which when I pulled this, which was 1 day later, 8.92, the portfolio's equities are up 7.81. If we look at bonds, bonds are up 0.22 and their aggregate bond index is down 1.56, right? Our alternatives, which essentially we own a bunch of gold, is up 4.67 versus the alternative index of 1.26. So you can go through this and say, if the model is correct, are we holding the right stuff for those asset classes, right? And that's this third part of our 4 key benchmarks to follow. And now the last part is, what is your objective? We have these investments. What is the purpose of these these investments? And for most of our clients, it surrounds retirement planning and our focus on retirement planning. And so we're looking for a specific outcome in their retirement plan. So I did a snapshot of a couple key pages here. So for this specific client, they have a 91% probability of success. Their assets at the end of life at age 90 in our plan has them at 2.3 million to 4 million, depending on their rate of return. So this is our real benchmark right here. This 5.86. That's our threshold. As long as we're
where's it 5.86? What's that 5.86?
That's their benchmark, that if we're looking for a fixed number from their financial plan to make sure that we receive a 91% probability and make sure that there's no changes in retirement, we need to hit that one number. And so for most of our clients, what we do is we look at that number on a year basis, number one. But number two, after 3 years, we say, since inception, are we trailing to hit this number here to make sure we accomplish your goals in retirement?
Oh, well, let me just interject. That's a fantastic approach. So I wish more people would do this, more financial advisors. Maybe they do now, I don't know. But to say, hey, our benchmark should be the success probability as opposed. I mean, we can compare. I get all that. But are we making our goals in terms of not running out of money, leaving an inheritance, funding various charitable things? If we can do that, we can do all that as long as we get what you said, 5.8% rate of return.
Yeah, for this client, it's 5.86%. And Josh, why don't you, I just have where I gathered some of these statements, but you can make us full large screen now for our
there you go. I don't know. Yeah, so that I actually think more people need to look at that and say, hey, my model for me is 5.86. If I'm underwhelming to 4.4, then I better ask my guy, why? And then there might be a good excuse is that, well, you're only getting 4.4, but the market as a whole, whatever the market is down 28%. So, we're not going to look at gift horse in the mouth. But I don't think enough people actually look at that personal benchmark, Amar. You know what I'm saying?
Yeah, I think that's the most important, right? Because that's what matters to you. Obviously, if your rate of return goes higher than that benchmark, your probability of success grows. Now you're leaving chips on the table, right? So I kind of look at financial planning from a different angle, is that you want to define what your probability of success is first. I want to have confidence that 80% of the time I'm not running out of money, or let me rephrase that, 80% of the time there's no change in cash flow. I may be okay for the last 10 years of my life to reduce my expenses, but I want to hit that 80% target, right? And so you do plus or minus, we use 5% on either side. So now we got a channel that we have to stay in. And if we're doing better on their investment returns because we're taking on more risk, or the return or the market or our security selection is better, then that gives you more money to put back into your pockets to spend the way you want. That could be either gifting to children, taking vacations as a family, buying a new car, but maybe getting if a car is important to you because it's your mode of transportation, maybe you get a little bit one with more safety features or whatnot. And so,
and I love how you put it too. 80% probability of not needing to change cash flows as opposed to 80% or 20% probability of running out of money. That's just a phrase I had never heard like that, Amar. That's fantastic. You have an 80% probability of not needing to adjust your cash flows. A 20% probability you'll need to adjust your cash flows.
Some people are okay adjusting cash flows because remember, Monte Carlo, the failure rate, if it's $1,000 or $100,000, it's considered a failure. Right. So, for most people, if they have to adjust $10,000, $15,000, in their 90s, I think they're okay with that.
100%, but that's a great way to phrase that though. So look, I've learned two things here. I love how you said the personal benchmark. I think that's just so cool. And then, not the failure rate. The failure rate implies that you're broke. It's not. It's just you might need to adjust cash flows, man. 100%, man. Most people will be willing to I call it tighten their belt. Most people will say, hey, I'm not going to buy the ribeye this year. I'm going to buy the ground chuck because, the markets are falling across the board. That's
And like I found from time to time that when you have a trade-off like that spurs a conversation of what's really important, right? And so in our financial planning, we call it the alignment model, which I used to work with a guy named Doug Lennox. He's written a number of financial planning books. He's been like the #1 author for FPA a long time ago. But anyways, he wrote the financially intelligent retirement, in the sense that you need to identify what's important to you, what experiences you want, who do you want them with, and then track your budget to make sure you're actually doing that. It's a lot of times that we have I want to call it lifestyle creep, but maybe keeping up with the Joneses in retirement, because you feel the longevity is creeping up and you want all these experiences, but you're not willing to give up the things that you should give up, right? Like you may still go out to eat every day, but you want to travel as well, right? It's like there's a balance between what, within your resources.
Economics would call that scarcity. You know what I'm saying? You can't be two places at one time. You can't spend the same dollar on two different things. You got to make a choice.
Yeah.
Dividend Gypsy says, do you have a target allocation to maximize risk-adjusted returns?
I mean, that's
Go ahead.
Yeah, that's on an individial basis.
Exactly. Get ready to say the same thing. That's to be specific to the individual, 100%.
Yeah, like in this client that we just looked at, on a $3.2 million portfolio, they want $700,000 cash. They don't want to have to worry if the market takes a dip and we get things wrong, and they're okay with it, right? And so risk adjusted is all dependent on your aptitude for risk. Risk. Here's one thing I will say with risk. When risk is increasing, correlations also increase.
Yes, exactly.
And people get this wrong all the time, because when they look at traditional asset allocation for a conservative investor, they think 80% in bonds is going to protect them, and that 20% of stock is what's really at risk. And that's proven time and time again, especially like in 2018, with COVID, stocks and bonds went down together, right? And so you're not getting
2022, same thing. It was 2022.
Yeah. So you're not getting that rebalance effect. So when you're talking about risk adjusted, I think that a portion of your portfolio that helps you sleep at night, that is, I don't want to say risk free, but low risk, that can buy you enough time for those risk assets to come back, probably does more for a risk adjusted return than anything else.
When one of the things I learned in 2008 was that when everything is falling to crap, everything's highly correlated. You know what I'm saying? In 2008, and the irony of it all, Amar, is I thought, because I don't know, in 2000, 2001, and 2, dividend stocks did fine. The growth stocks got crushed, but everyone, S&P was so heavy into growth stocks, everyone thinks the S&P 500. But then 2008, dividend stocks got crushed, as did everything except government bonds. So you're thinking, okay, government bonds are the way to have a low correlated thing in a down market. No, 2022, everything got crushed. It's the risk, as everything falls to poop, the correlations increase across the board, man. It's nuts. And there's no escape other than very, very low risk things like money markets and cash, for sure. Yeah. Here comes James. A lot of people say they have a high risk tolerance, but when they went through 2000 to 2008, it was hard. Yeah, 100%. James, 100%, man.
Yeah,
Absolutely.
I mean, I would say, aggressive investors are really aggressive until they start to lose money. They become conservative investors, right?
No, and then they're like, "Why didn't you take me out, Amar? Why didn't you take me out?" You're like, "We need to get that 5.8%. We're not gonna." Hey, yeah, you're working at Vanguard. This guy was a Vanguard guy at 2008. All right, cool. Dividend Gypsy. Where were you at there? I worked at Camelback Road Vanguard, and then we moved up to Scottsdale. Then they learned too late they can't take it, James. That's the issue. Like, I'm a risk tolerant guy. I don't want to be down 5%. In fact, there's you ever watch or read MarketWatch.com?
Sometimes. I've been quoted there 2 times.
Really?
Yeah, you probably read some of my quotes.
I threw arrows at it. I said, this guy sucks. And then
sure.
Then one guy said, I had $700,000. We're down $35,000. What do I do? I was like, dude, it's like you're real. Jeez, man. I'd hate to be your advisor. That's for sure.
Volatility is the price you pay for long-term returns, right? It is, investing without volatility, you should just be in cash.
100%.
But all right, we're at 30 minutes. Do we have any questions?
Any other last thoughts from Mark? Questions, comments? We'll be going, my friends, while you're thinking about any comments or questions, throw them up here. I just can't stress enough how important the benchmark is. It's and how important your own benchmark is. That's a fact. So don't let these guys say, bamboozle you comparing the S&P 500 as you can do that, but say there's more to this than that. I just drives you up the wall. Mar, you might have been at USA, and I'll let you go here, but back when we were crunching numbers, they still had cash at it was like 5 or 6%. I'll never forget, on our portfolio. So everyone was coming in 100%, and they had cash, I forgot what it was. I was like, dude, cash is paying 1. You're like, no, but it historically was paid this. I said, what are we doing? It was insane. And then they had a benchmark that was, I'm not trying to bash USA, but there's a reason they no longer do this anymore. But they had benchmarks. So that's crazy, man. But
yeah, so the purpose of this whole 30 minutes here was so that you could go through these steps. You can rewatch this video. You can take paper and pen out and put pen to paper and create those 4 different benchmarks and evaluate your own portfolio to see hey, are you on track for what your goals are? And remember,
shout out your newsletter, by the way.
Yeah. So real quick, the three parts are the return, the risk that benchmark is taking, and then why is your portfolio different than that? And I guarantee you it's going to be different. But as long as you know why and that helps you sleep at night, it's good. Hey, you can find me in 3 different modalities. So first, we have Client First Capital Learning, which is a YouTube channel where we create videos once a week just on educational topics around retirement, taxes, estate planning, and charitable giving. The second thing is you can just go to our website, which is clientfirstcap.com. We have a ton of resources there. And the third is we have a newsletter which you can sign up for. It's just 10 news. We start with a get to know you, a couple emails, and then we have 10 emails that go out once a month for the remainder of the year. So please look forward to connecting, and thank you, Josh. And till next time.
Wait, you can jump off if you need to, Amar. I'm going to answer this question here. You got a couple more seconds to answer a question?
I got time.
All right. So even though Pulverizer says right here, here's Darren Sale. When is it important to get a CFP on board to evaluate your upcoming retirement? A year out or 3 years out or something else? You got any thoughts on that, Amar?
Well, if it's important to you to retire, I mean, I would think the earlier the better. We've worked with clients 10 years out from retirement, 5 years out, and hey, I just found out I got a severance and I'm retiring at next week. And so I would say the earlier the better, because you want to know if you're on track or not, right?
Yeah,
Like I think about this as like planning a vacation, right? When I plan a vacation, we're going to go skiing over spring break. We're already planned. It's been like 4 weeks of planning for this 1 week vacation, right? Your retirement's going to be 40 years. We got to spend a little bit more time planning just to know where we are. Darren, you may realize that you can retire now and you can do something different.
Exactly.
That would be important to know, 100%. Right?
And I couldn't agree more, Mar. I talk to people all the time. Like, I just got to talk yesterday. I thought I'd wait till I was 65. Started watching your channels, Josh. I said, I think I might be able to do it. And he's moving to, they're not moving they're moving to Arizona. I was going to say San Diego. And he's like, I think I can do this. We cranched the numbers. I said, dude, you know what I'm saying? But he was like, I didn't know. I said, I know. So don't just sit there and say, I can't do it until you know for sure. Now, that doesn't mean you got to hire somebody, but you always got to look at expenses, Darren. What are your projected expenses? If you don't know that, then you're flying blind, man, and we can't have that for sure. We need to know.
Expenses are the number one thing in retirement, right, Josh? Mm-hmm. It's like that's the only thing that you can control in retirement, 100%.
100%. All right, man. Thanks again. We'll see you in 2 weeks, and hopefully we'll jump on your YouTube channel and newsletter, Mar. Much obliged, man. See you. Thanks, guys, for being here. Appreciate it. Every other Wednesday, be here or be square, and we ain't square here, okay? So be here or be square every 2 Wednesdays. All right, see you guys. Thanks, Dan.
All right. Bye now.
All right. And stream.